Okay, let's unpack this. Have you ever really considered what happens to your money when it's invested in global stocks over decades? I mean, not just the big flashy numbers, but the true growth,
Well,
the actual purchasing power your money holds. Today, we're taking a deep dive into 40 years of global stock market performance, specifically 1985 to 2024. And we're really focusing on that crucial difference between nominal and inflation-adjusted real returns. Now, the challenge is popular tools like Vanguard's Total World Stock ETF or its benchmark, well, they just don't have that kind of history. So our mission is to cut through the data noise using a robust historical proxy to give you a clear long-term picture.
yeah, and what's fascinating here, I think, is that while those nominal gains often grab the headlines, understanding your real return, what your money can actually buy, that's where the true insight for investors lies. It's really about how your wealth genuinely grows against that persistent erosion of purchasing power from inflation.
That's such a crucial distinction. Makes perfect sense why we needed a solid proxy for this long-term view. So tell us, how did we actually establish the reliable historical lens for such a huge period?
Well, we leaned on the MSCI World Index. It's incredibly reliable for developed markets. You've got the U.S. making up over 70% of its weight, and the data goes all the way back to 1970, which is key. Now, a key nuance, is that it primarily covers developed markets, unlike a total world index, which would also fold in emerging markets.
Okay, so it's missing emerging markets. Does that skew things much?
That's a fair question, but actually, when we looked at a comparison over nearly 25 years, from December 2000 to August 2025, the MSCI World Index slightly outperformed the MSCI ACWI, and the ACWI does include emerging markets. The MSCI World delivered 7.04% annualized net return versus ACWI's 6.92%. So that performance similarity suggests our proxy is actually very robust for understanding these broader, long-term global market trends.
Right, okay. Robust enough for our purposes then. So, with our reliable proxy in hand, what did those 4 decades actually deliver? What were the headline nominal returns? And more importantly, how did inflation kind of stealthily chip away at them?
Exactly. That's precisely it. Over those 4 decades, our MSCI World Proxy delivered a really powerful nominal return. We're talking a compound annual growth rate, or CAGR, of a whopping 11.30%.
Wow, 11.3% sounds amazing.
It does, right. But here's the kicker. The average annual U.S. inflation over that same period, using the CPI-U, was 2.80%. So when you adjust for that persistent inflation to your true growth, your real CAGR, it comes down to 8.27%.
Okay, so 8.27% real growth, still strong, but quite a difference from 11.3%.
A substantial divergence, yeah, between what the numbers say you earned and what your money could actually buy.
And what a ride it must have been to get to that 8.27% real return. I mean, this wasn't just a smooth climb up, was it? The journey started with a boom. Like, wasn't there a huge gain in 85?
Oh, yeah, a massive 41.77% gain in 1985. But then, boom, Black Monday hit in 1987. And then you had the really brutal lost decade from 2000-2009.
That lost decade. What's the biggest lesson we can draw from enduring something like that? Such a prolonged downturn.
Well, that lost decade was a real gut check. Seriously. The dot-com bust gave us 3 consecutive years of double-digit declines. Think about it, negative 12.92%, negative 16.52%, and then negative 19.54%, back to back to back. And then that was followed by the devastating 2008 global financial crisis, a nominal decline of negative 40.33% in just 1 year.
40%, wow.
Yeah. So for an investor who, say, started right at the peak in 2000, it would have taken them over a dozen years just to get back their initial investment in nominal terms.
And for 12 years just to break even?
Nominal.
Exactly.
It's a powerful reminder of how patience, or, the lack of it, can dramatically change your outcome. But then came the post-crisis bull market, which rewarded that patience. We saw gains like 27.37% in 2013, 28.40% in 2019. And even recently, we've seen significant volatility again, like that nominal downturn of negative 17.73% in 2022.
And that 2022 downturn is a perfect recent example of inflation's hidden bite, isn't it?
Absolutely perfect example. When you factor in the 8% inflation that year, that nominal market drop actually meant a real loss of negative 23.82%. It just really highlights the profound impact rising prices have on your actual wealth, your purchasing power.
Okay, let's try and put this into perspective, make it tangible. Imagine you invested, say, $10,000 in this globally diversified market back in 1985. 40 years later, what would that investment be worth today, both nominally and crucially in terms of real purchasing power?
Right. So nominally, that $10,000 grows to approximately $731,900 by 2024.
730 grand. That sounds incredible.
It does, a fantastic number on paper. However,
Yeah.
when we adjust for the cumulative impact of inflation over those 40 years, in terms of real purchasing power, what it can actually buy today, that $10,000 is only worth roughly $231,600 in today's dollars.
Okay, so from $731,900 nominal down to $231,600 real. That's a huge difference. It's massive. And if we connect this to the bigger picture, this stark contrast really illustrates powerfully that over the long term, inflation isn't just some nuisance. It's a constant, significant force that shapes your actual economic gains. It often acts like a silent thief of wealth.
A silent thief. I like that.
Yeah.
So, stepping back, what does this whole deep dive into 40 years of market history truly mean for you, the listener, beyond just the basic investment advice?
Yeah, I think this deep dive reveals three critical realities that are perhaps often underestimated. First, the sheer resilience of global diversification and compounding is profound. I mean, even after multiple crashes and a whole lost decade, a globally diversified portfolio delivered substantial real wealth. Second, a long time horizon. It isn't just a suggestion. Enduring periods like that 2008 real loss of over 42%, well, that's essentially the cost you pay for earning those powerful long-term real returns.
The cost of admission, so to speak.
Yeah.
Exactly. And finally, inflation isn't just some transient event we see now and then. It's a permanent, relentless factor in finance. Ignoring it basically means you're miscalculating your actual financial progress. And, this raises an important question about how we set future expectations based on this history. While that 8.27% real CAGR is a really powerful historical baseline, we always have to remember, past performance is not a guarantee of future results. It's a guide, sure, but definitely not a crystal ball.
Absolutely crucial point. Okay, so let's leave you with this provocative thought to mull over. How will these deep insights into global market history, and especially the persistent silent impact of inflation, how will that shape your personal investment strategy and your expectations for the evolving global economy ahead?